Welcome to the deep dive. So, you've sent over a really interesting mix of stuff on ICICI Lombard General Insurance. We've got their Q4 and full year FY25 results, a business strategy overview, some great questions from you, and even the earnings call audio.
Right. Quite a comprehensive package.
Exactly. So, the plan for this deep dive is basically to pull out the really key insights, figure out how they've done, where they're heading, without drowning in spreadsheets.
Makes sense. It's about understanding the story behind the numbers, the strategy they're following.
Okay, let's get into it. Starting with the big picture, their financial performance. For the full fiscal year 25, their gross direct premium income GDPI, yeah?
GDPI.
It hit 268.33 billion. Now that's an 8.3% increase year on year.
Which is pretty good, especially when you see the whole industry only grew about 6.2% in the same time frame.
So they're definitely outpacing the market there. Any initial thoughts on why? Are they particularly strong somewhere?
Well, yeah, that's the key question. Looking at their strategy docs, they're pushing diversification, different channels. It's likely strength in specific areas, maybe motor or health, or perhaps some successful tie-ups are driving that outperformance. Oh, and there's that accounting change, too, from October 24. The one basis thing mandated by IRDI.
Right, that makes direct comparisons a bit tricky.
It does. If you adjust for that, their growth looks even stronger, about 11.0% against an adjusted industry growth of 8.6%. So still well ahead.
Okay, that's a good point, good context. And zooming in on just Q4, the last quarter of FY25.
GDPI was 62.11 billion, up 2.3%, again slightly ahead of the industry's 1.7% for that quarter.
So consistent outperformance. Now, profitability, the combined ratio, that's always a crucial one for insurers.
Absolutely. And theirs for FY25 was 102.8%. That's actually a slight improvement from 103.3% in FY24.
So just for anyone listening, over 100% means they're paying out more in claims and expenses than they're earning in premiums, technically an underwriting loss.
Exactly. But that 102.8% includes some big catastrophe losses. If you strip those out, what was it? Euro 0.94 billion in FY25 versus 1.37 billion the year before.
Yep.
Then the underlying ratio improved a tiny bit too, from 102.5% down to 102.4%. Yeah, well, heading in the right direction despite the challenges.
Okay, but then look at the net profit after tax, the PIT. This jumped massively for the full year.
Okay, that was striking.
30.7% increase, up to 25.08 billion from about 19.19 billion. Huge growth.
Huge.
But then in Q4 specifically, PIT actually dipped slightly, down 1.9% to 5.1 billion. How does that work? Strong year, weakish finish.
Well, quarterly PIT can bounce around a bit. Could be timing of big claims hitting in that specific quarter. Maybe investment income fluctuated. It's tough to say exactly without drilling down further, but that big jump year on year really suggests the overall strategy is working, driving bottom line growth.
Definitely sends a strong signal. And good news for shareholders too, potentially. The board's proposed a final dividend, 7.0 per share.
That's right, bringing the total for FY25 to 12.5 per share.
Which is up from Euro 11 last year. Still needs shareholder approval, obviously.
Of course. And one more key metric, return on average equity, ROAE. That also improved nicely. Reached 19.1% for FY25, up from 17.2% in FY24. So they're generating better returns on the shareholders' capital. Ties back to that improved profitability.
Okay, so overall, financials looking pretty solid, quite strong actually. Let's dig into the how now. What's driving this? The strategies. Diversification seems key.
It does. They've got really wide range of products, motor, health, crop, fire, you name it. But yeah, looking at the contributions, motor and health are clearly the big engines.
Right. Motor insurance grew 11.5% in GDPI for the year, and they actually increased market share slightly to 10.8% from 10.5%.
Yeah, and they talk about granular portfolio segmentation and prudent risk selection.
So granular segmentation, that basically means they're slicing and dicing the market more finely, not just car insurance, but looking at specific driver types, locations, vehicle ages.
Exactly that. Diving deep into data to understand different risk profiles within the motor segment allows them to tailor pricing, maybe attract lower risk groups, and hopefully underwrite more profitably than just a blanket approach. It's more sophisticated play.
Makes sense. Okay, and then health. Another huge area, biggest for the whole industry. Right?
Yeah, massive. And ICICI Lombard's retail health part grew 12.1% in FY25.
Strong. But it was interesting seeing the different loss ratios they reported. Corporate health was high, like 97.6%, while retail indemnity was much lower, 67.9% for the year. big difference.
It really highlights the different dynamics.
Yeah.
Corporate group policies often face tougher pricing, maybe different claims behavior, leading to those higher loss ratios.
Yeah.
Retail individual policies, they seem to be managing the profitability much better there based on that number. You really have to look at them separately.
Got it. Okay, how are they selling all this? Distribution, big agent network, over 140,000?
Yeah.
Yep, the traditional channel is still significant, but the digital push is really noticeable.
Yeah, that IL Take Care app, 14.9 million downloads. That's a lot.
It is. And look at the jump in customers using their cloud, calling for motor insurance, 86% in FY25, up from just 49% the year before.
Wow, that's a huge shift. Shows digital adoption is really accelerating for service interactions.
Absolutely. It ties into their whole tech focus. It's not just customer-facing, it's core to underwriting and risk, too.
Right. They emphasize risk selection using data analytics and that conservative reserving approach.
Yeah, they consistently report reserve redundancy, which suggests they're setting aside perhaps a bit more than needed for claims, erring on the side of caution. It's prudent.
And their solvency ratio is super strong, 2.69 times the requirement. Lots of buffer there.
Definitely. Very well capitalized, gives them resilience.
And customer service seems to be getting attention too. Claim times are down motor OD claims from 6 days to 5 days.
That makes a difference to customers. And their Net Promoter Scores, NPS, look pretty healthy. 67 for health claims, 69 for motor in the first 9 months.
Plus, they're getting more claims handled through their preferred garage network for motor, servicing nearly 3/4 of non-OEM claims now.
All those little improvements add up to a better customer experience, which is crucial for retention and reputation in insurance.
Yeah. And the underlying tech push, AI, machine learning solutions, and being the first big insurer here to move core systems to the cloud.
That cloud migration is a big deal. It potentially offers more flexibility, scalability, maybe faster innovation down the line. It signals a real commitment to technology leadership.
Okay, so that's a lot of positives on their strategy and execution. But let's widen the lens a bit. The industry context, the challenges.
Right, because it hasn't been smooth sailing for everyone. As we said, overall industry growth was 6.2% for the year, but slowed quite a bit in Q4 to just 1.7%.
And while ICICI Lombard improved their combined ratio slightly,
The industry as a whole went the other way. The combined ratio worsened to 113.2% for the first 9 months. Even for private players, it was 111.21%.
ouch. And that was largely driven by motor insurance, wasn't it?
Yes, the motor segment has been tough across the board. So ICICI Lombard, managing to improve profitability, even slightly, against that backdrop is actually quite impressive. Shows their underwriting discipline might be paying off.
The earnings call mentioned some reasons for the slowdown, vehicle sales being a bit sluggish, definitely some intense price competition in motor.
Yeah, they specifically called out aggressive pricing from some PSUs, public sector undertakings.
Right. And they also noted softer rural demand for two-wheelers and tractors in Q4, plus government spending being kind of flat, which impacts commercial lines.
Though they did mention a potential uptick in capital expenditure later, which could help commercial lines down the track.
We also have regulatory changes stirring things up, the cap on premium hikes for senior citizen health policies.
And the Bima Sugam platform coming online eventually. That could really reshape distribution.
So lots of moving parts. Faced with that aggressive PSU pricing in motor, ICICI Lombard's response seems to be stick to our knitting, focus on prudent underwriting, brand, tech, service.
Pretty much. They seem to be playing the long game, believing that focusing on profitability and quality will win out over just chasing volume with unsustainable pricing.
And those expensive management, EOM guidelines being discussed with a deadline in March 2026 that could force more discipline across the market, perhaps.
That's the hope, I think. If everyone has to manage expenses within certain limits, it might reduce some of the purely price-driven competition and lead to more rational behavior overall.
Okay, so looking ahead then, what's the management outlook? What did they signal?
For the auto industry itself, they're expecting sort of mid-single-digit growth next year. But they're still pretty positive on motor insurance prospects, partly due to better penetration in older vehicles needing insurance renewals.
And health.
Still expecting strong double-digit growth there, driven by rising demand, awareness, and, unfortunately, medical inflation, which pushes up premium needs.
They also mentioned things like recent income tax relief, potential interest rate cuts. Could that help?
Yeah, the thinking is that boosts disposable income, maybe credit growth picks up, and that indirectly fuels demand for insurance products as people feel a bit more financially secure or are taking out loans that require insurance. potential tailwinds.
And strategically, it sounds like more of the same focus. Profitable growth, customer experience, data analytics, tech-first approach.
Exactly. No major shifts signaled there.
Yeah.
And they kept their long-term return on equity target range unchanged at 16–20%.
We also saw the board-approved Perrick and Associates as secretarial auditors for the next few years. Standard governance stuff.
Pretty standard, yeah. FY26 to FY30.
And finally, there was a mention of receiving some tax assessment orders, income tax, CGST, central excise, anything major there.
Doesn't seem like it based on their commentary. They stated they believe their tax positions are legally sound and they're filing appeals. It sounds like part of the regular back and forth for a large company dealing with complex tax rules.
Right, happens. Doesn't seem like a major red flag at this point.
Seems like business as usual, being handled through the proper channels.
Okay, so let's try and wrap this up for our listeners. The key takeaway seems to be ICICI Lombard had a strong FY25. They grew faster than the industry, improved profitability slightly despite tough market conditions, particularly in motor.
Yeah, their strategy focusing on diversification, digital adoption, disciplined underwriting, and customer service appears to be working quite well for them. They seem resilient.
Showing resilience in a challenging market, navigating those headwinds while still delivering growth and better returns, their strategic choices look pretty well aligned with the current landscape.
Agreed.
Which leads us to the final thought to leave you with. Okay, they're outperforming now, but considering how competitive the market is, the PSU pricing pressure, the regulatory shifts, how sustainable is this outperformance? What are the key things you should watch? Maybe market share trends in motor, loss ratios in health, adoption of digital, regulatory impacts to gauge if they can keep this momentum going in the Indian non-life insurance space.
That's the critical question looking forward. Plenty to keep an eye on. We definitely encourage you to dig into the full reports and industry data yourself, using these insights as a starting point.
Absolutely. There's always more beneath the surface. Thanks for joining us for this deep dive.
Thanks, everyone.
We'll catch you on the next one.